investing. All right, I won't elaborate too much into this category, as it's actually a lot of information when it comes to investing. Everybody wants to be the biggest winner. Think about investing, it's like gambling. You could wind up being the biggest loser. What you want to do, you just want to have a philosophy on how you invest. The main thing you want to do it periodically. Have a regular scheduled amount of investing. Like I say, I invest $100 every month. That's about it. Maybe 200. When I have some extra money, but I invest $100 every month, and it's just a way to save. And like I say, I use my investment accounts as a savings account. Earlier, I said about having a rainy day fund for only 1 month. Most financial advisors recommend 3 months of having. But like I said, I save my money in investment accounts, because with it, if I have enough for a month, I have time to liquidate any investments accounts I might need, at least portions of it anyway. I would put my money in the market. It's some safe things that you can do. There's nothing that's totally safe, but there are some things that are fairly safe to save your money, that'll earn you some money. The best thing about investing is that your money can potentially beat inflation. What it does, it increases the value of every dollar that you earn. If you invest $100 at the end of the year, it could be worth $120. Where inflation would make, if you just had it, $100 bill laying under your pillow, it'll probably be worth $97 instead of the original 100, because it can only purchase $97 worth of product and service now. Whereas investing with some, dividends or some gains, it can be worth $110, $120. So what it does, it beats inflation. So the value of each dollar that you earn is greater. If you minimize your fees, from your broker or whatever, it's still better than, just having a $100 bill laying under your mattress or whatever. Like I said, you invest periodically in what they call dollar cost averaging, which actually you make more percentage than day traders. It's been shown that if you dollar cost average over a period of time, you eventually have a better, gain percentage than people who trade on the market day to day. So something interesting to consider. One thing I would do, I would avoid individual stocks. Individual stocks are just stock offerings from one company, say GE or Walmart or Google or something like that. Try to avoid those stocks, because most established companies stock doesn't go up too much. So if you're looking to invest in a big company, their stock's really not going to go up too much. They're probably already elevated at a level. Like I said, they're too risky also, too much up and down. Like what you want to do, you want to invest in ETFs, which are electronically traded funds, and mutual funds. They invest in many companies or many industries at once. So, you might have an oil fund that has like all these different companies in it. So one company's failure won't hurt the entire fund. And usually the people who manage those funds, they go through a process of choosing the best stocks to put into their fund. So it's, like I said, just, you want to invest in ETFs and mutual funds. And like I said, I would invest about 50% of your savings into some good funds that are precious metals. When the market's doing well, put your money in precious metals. And if the market keeps going up over a period of time, I would invest in precious metals, because once that market goes down, the value of your gold fund or your silver fund goes up, because people are going to start safeguarding their money there. So the value of that stock goes up. The value of that stock over a period of time just goes up. There's no major dips over a period of time. It just goes up. So it's a good way to save your money. Also, bond funds, the aggregate bond fund, it's a good way to safeguard your money. And it also pays dividends, and it pays dividends monthly. Dividends are just payments on your stocks as a stockholder, and it's a good way for your money to earn money. Index funds, when a stock has done poorly for a long time, I would start investing in index funds. Like I say, once the market goes down a bunch, if it goes down 2,000 points, 500 points, it'll go back up, because people will start finding deals. And once they find deals, the value of those index funds goes up. Medical funds, stocks in the medical industry, those always go up, because even if medical prices stay the same practices, there's always going to be more and more people who need doctors and nurses and medical supplies. Those are things that are based on people. So it's always good to invest in medical funds. Like I said, they'll have their ups and their downs, but over a period of time, which is how you want to invest if you're a working person. You want to look 10, 15 years down the road. You're not trying to look to cash out, a year and a half from now. You're looking 10, 15 years down the road. Where's your money going to be? You invest $200 a month for 10 years. It's a lot of money that you could be saving. If you're 20 years old and you start that now, 30 years old, you'll have enough money to purchase your house. Like I said, it's just a better way to save your money. It's a lot of funds to look into: real estate, telecom, financials. You have to do a little homework in this. Like I said, it's already a lengthy video, and I haven't even got into anything yet. These are some fundamental things I think that'll help you out in the future. So you can, exchange currency. It's so many ways people try to make money. But like I said, I wanted to keep this simple and easy for me as well as for you. Review what I'm saying. Study it a little bit.